So, welcome everyone. I guess we will kick this thing off. We have it scheduled for 30 to 45 minutes, depending on how aggressive you guys get with your questions. I, of course, am Andrew Rosen, President of Diversified. We have our Chief Investment Officer, Mike Horwath, who's really going to lead the show today. He's got about 25 to 30 minutes prepared of slides and discussion, and then he is going to open it up for Q&A. The way we'll handle that is I'll take written questions. Please write them as you think of them, so we can get right to them, keep it efficient, and if no questions, that's okay too. But just type them in the little question bar on the Zoom link, and I'll procure them and ask away when we get done. So, as you know, we do this quarterly as a get back in education and keep our clients informed, hearing from the man in charge of our billions of dollars. So, Mike Horwath, without further ado, why don't you blow our minds?
Yeah, it's hard to do. I'll do my best. Welcome, everybody. My name is Mike Horwath. This is our normal quarterly, we call it market and economic update. Ultimately, it's just kind of what that says. We're here to review what's going on in markets, in the economy, in headlines, things that we're thinking about in portfolios, things we're concerned about. We try to touch a little bit of everything. As Andrew said, we do this quarterly. The replay of this will come out shortly. Our marketing team will get it out on social media and make sure it gets sent out to everybody. So that will come out soon, along with the quarterly newsletter. That is something that I put together. It's essentially a written version of this, a little bit more granular, a little bit more detailed if you prefer to read. If you got nothing to do, feel free. If you delete it, that's fine. I don't take any offense to it, but just know that's coming out, and you can expect that here in the coming days. But a lot to review for the first half of the year. The theme of the newsletter and the thing that I think is really important that people remember at a point like this is controlling the controllables. A lot of the questions we're getting nowadays are around inflation, around rates. What you realize as you do this long enough is a lot of these variables are just not controllable really at any level. And we have to keep the bigger perspective and the bigger objective in mind when we're investing and we're trying to kind of weather markets across any real economic conditions that we come across, right? And even for the last decade, we've seen a lot of different environments that have come through. But, when we look back at the first half of the year, the biggest really risk to markets is economic growth slowing. The good news on the right-hand side, you'll see this is what they call the Atlanta Fed GDP Now report. This is kind of a live, real-time GDP estimate that they do quarter to quarter. And while we've seen some pullback in expectations around growth, the good news is that growth is still expected to be right around trend, right? When we say trend, we're still talking right about 2% real GDP growth, which is really where we've been for the past couple of decades, right? And we've ebbed and flowed, a little bit above it, a little bit below it, but a 2% GDP growth keeps us where we really need to be. Naturally, the focus has so much been around inflation. We'll talk a little bit above that, but main story has been inflation's come down. It's kind of plateaued right around that 3% mark. And depending on the way you want to interpret it, some people get a little bit concerned about it. Some people are much more in the we're in great shape camp. We can talk about where we stand, how we think about it here shortly. The Fed, as that kind of ties together, is very much dependent on what happens in the inflation conversation. So when we think about where they're at today, where they're going, the Fed's going to be really focused, and they've been focused since mid-23. So in July of 23, it was that last rate hike. They have paused since then, and the question is, when do they start cutting? It's a matter of kind of when, not if they do that. So they will cut. That will be their next move, just when. And, I think we can really kind of play what's going on in the market and kind of break down what the probabilities are of when that starts to happen. But rates will start coming down here shortly. Good news, we talk about it a lot. Our corporate fundamentals have been really strong, and it really has been one of the main drivers of really market growth over the course of this year is earnings have remained really strong, profit margins have remained really strong. It kind of all ties back. Labor market has been strong, ties back to the consumer spending, tying into top line growth for corporate fundamentals. So a lot of things are working in the favor of the economy remaining pretty strong. It doesn't mean that there's nothing potentially out there at risk, but when we say take a 30,000-foot view, things have remained pretty strong. As we kind of dig into what happened into markets, a lot of you have felt it, have seen it in your portfolios. Equities continue to drive really returns this year, which is a story of 2023 as well. So far this year, global markets are up about 11-ish% on the equity side. US large cap driving most of that. US small cap has really actually been quite a disappointment. Part of it is just this uncertainty around rates. Small cap stocks have been a little bit more sensitive to movement in rates. It's been, days when markets are pricing in higher rates or rates coming down slower. Small cap tends to struggle and vice versa relative to large cap. On the bond side, it's really been a story that we've talked about, and we'll go through it a little bit more, but it's just been this kind of status quo in the bond markets. After a pretty decent 2023, it's been, at points this year, bonds were down 2-3%. They've come back since. They're right around kind of treading water, if you will. And a lot of this comes back to just where rates are. The good news is that our starting yield in fixed income remains pretty strong. Where we're yielding today, not even just cash markets, right? Go beyond cash markets, even look at core fixed income, core treasuries, corporates, structured, whether that be mortgage-backed securities, commercial mortgage-backed securities, yielding 5+%. Good place to be relative to where we were a few years ago. The answer that really has to come to fruition, though, is where do rates go? And I think at that point, you'll start to really see fixed income just at least find its footing, right? And I think that's been the story this year. It just hasn't found its footing because at the end of last year, markets got ahead of themselves. This year, they're just trying to reconcile where the Fed's going to go. Interest rates continue to really be the primary story, right? And I think I love to show this graphic and just kind of highlight where we are today and where the market's projecting. So clearly today, we are at the top of what the market's projecting. You'll see some people throw out crazy expectations around, well, what if the Fed's raising rates, right? Should the Fed raise rates? Again, that's not really on the table. What they'll do is they'll temper expectations around cutting, and maybe they'll keep them status quo for a little while. I mean, they've kept them status quo for really a year at this point. But raising rates, a lot would need to change for them to be willing to go back to hiking rates again. They know if they were to do that, markets would react very, very negatively because of just how big of a change in expectation that would cause. We're not there. We need to see inflation really reaccelerate, and that's just not what you're seeing, underneath in the data. And then where you see is, look, if we're at 5.25% to 5.5%, not only is the market in green expecting rate cuts, the Fed itself in blue is projecting rate cuts. And look, the long-term expectation is that we're above where they want that long-term short end of the curve to be. The path for rates is down. The question is when and how much, right? I think those are clearly two debatable conversations, but it's not a question right now of are they going to hike again? Are they going to cut? They're going to cut. It's just when. We can kind of tie it back to really what markets are pricing in. The interesting part, and I probably should have overlaid it here, is where if we did this same exercise in December of 23, which we did, and you show the comparison at the end of December in 23, markets were pricing in 5-6 cuts for this year. The Fed wasn't expecting that. The Fed was saying 3, but the market kind of got ahead of itself given some softer inflation information. So what we've seen this year is kind of this adjustment period where Now the market's trying to find its footing on the rate side, and you see what that market expectation are. These are probabilities of where rates will be after the December of 24 Fed meeting. So there's a couple between now and then, but I went and fast forwarded ahead to December of this year and said, where are we today? Which is actually on the far right-hand side. So the market's pricing in a 7% likelihood that rates don't change. But clearly, the focus and the expectation right now in markets is that there will be 1 to 2 cuts this year. Seems pretty reasonable, seems pretty aligned with what the Fed says, but there is this, potential that, if the economy, markets hold up, labor market stays strong, and inflation stays at, call it 3.5%, maybe they do hang on to the rates where they are today, and they say we're going to pivot and start to cut in 25. But I think it's reasonable to expect 1 to 2 cuts this year. And that's what the Fed has really said, and it's what the markets are pricing in at this point. The question then and the risk goes to just GDP growth, right? Growth has to remain pretty strong for the Fed to remain confident that they don't need to cut rates. So I think on the downside is if you do get quicker rate cuts, it means something has likely broken, which is not necessarily a good thing. Where they moved rates to, right? They moved rates up. It gives them what we would call kind of an arrow in their quiver, that if growth slows, if unemployment increases, if something negative were to happen in markets or the economy, that they now have an arrow in their quiver that they can cut rates to try to stimulate the economy. One of the concerns you'd have back at the end of 21 was that nothing was there for them to really do. Rates were so low at the end of 21 that, if something were to happen, they can't cut rates. They're already as low as possible. So what we're seeing is, the opportunity for growth to continue driving forward, remaining at trend. And as long as that does, which is what the projection is, that the Fed doesn't feel like they need to cut rates. It buys them time for inflation to kind of come down, which is really, I think, the most ideal scenario as we look forward. We don't necessarily need rates to get cut quickly, because I think that scenario, like I said, is probably a negative scenario that they're forced to do so. The inflation conversation it's all over the place in many regards, because you're seeing so many different ways of individuals interpreting what's going on on the inflation front. The big reason for that is you saw inflation really peak and then come down quickly. The thing is, at this point, it's really just plateaued. It's plateaued right around that 3.5% year over year. And if the Fed is targeting 2 to 2.5%, you're going to get a lot of those reports. Well, is inflation reaccelerating, or is inflation sticky and the Fed needs to continue hiking rates? We're not there. Going from 6% inflation down to 2%, it takes time. It's not going to be a straight line. What we are seeing, though, and what this graphic is showing you, are all those different components of CPI, which is the Consumer Price Index. The percent of them that are above or below that 2% target. And what you're seeing is those individual components, right? And they all have their own different weighting, but those individual components have finally gotten below kind of that long run average. And you're starting to see some of the underlying components start to come down. Now there's work to be done, and you can look at different areas. Most of the issues remain in the service sector. Most of the issue remains in housing, right? Or really what you'd call owner's equivalent rent, things like that from a housing perspective. But overall, you're not seeing this widespread issue from an inflationary perspective. You're starting to see things cool off a little bit. There's just work to be done. And this is why the Fed wants to remain patient, wants to remain data dependent. They're not in a rush unless they feel like they are required to start cutting rates. And I think, this is where we would say, 1 cut this year, be fair, right? I think that's, not necessarily a bad thing. And I don't think people should look at it as a bad thing. On the equity side, the conversations remain, we'll talk about it a little later, just how, what from a pricing perspective, markets have just just ripped over the course of the last 18 months from the beginning of 23. They've performed really well. We've hit all-time highs. You consistently hit them. And the question we get is, how can it keep going? And naturally, you have to zoom out, because I think if you look at any one data point, it can skew and things can look expensive. But when you actually look at why things are performing the way that they have, this graphic here, at least on the left-hand side, shows earnings growth year over year of US equities, right, which is measured by the S&P 500. So earnings per share growth, earnings growth. And if it's positive, it means earnings are growing year over year. If it's negative, naturally, earnings are dropping. What you're seeing is projections for 24, 25, and 26 to be nearly double digit, if not double digit earnings growth year over year over year. And where that puts not only earnings overall, from a valuation perspective, it puts it in a really good spot, right? And this is why you're seeing markets comfortable with the S&P 500 going over 5,200, 5,300. You're seeing these numbers get hit, and now all of a sudden you're seeing projections out into the mid 5,000s, high 5,000s on the S&P, because these earnings numbers have broadened and they've continued to kind of stay resilient. Part of it is on the right-hand side. When we talk about profitability, not only are you seeing top line revenue growth be pretty strong, and I'd say a 3% inflation number shouldn't concern people in many ways, because not, while it hurts purchasing power, what it does do is from an equity perspective, companies that can pass that along, that helps drive their top line revenue growth. On the right-hand side, what you're seeing though are profit margins have remained as healthy as ever, right? Maybe not quite as high as we were back in 21, but you're still seeing 12% margins from the average US equity. So earnings growth strong, profit margins remain strong. You're seeing projections from an earnings perspective continue to rise. And this is why you're seeing valuation multiples continue to move up across the earnings spectrum. This is very different than what we saw. We always get the tech bubble conversation from 2000, 2001. That rise was driven off of more speculation, whereas earnings were just not there. Well, we're seeing earnings really strong, and that's what's driving this equity growth that we've seen over the course of the last 18 months especially here in the US. I think the concern becomes, what you have to worry about is what's driven markets up to this point has gotten us pretty concentrated. And this is something we try to remind people of, why rebalancing is important, why zooming out is important, is because this is what can happen in portfolios. And when you look at the top 10 names of the S&P 500 as an example, they're most of the big tech names, some of the strongest, most profitable companies that we have, not only here in the US, globally. They will be the biggest part of your portfolio, but what you have to be careful about is how much of your portfolio are they? Because when you look decade over decade, we always remind people, if you look at the top 10 names from 2000 and the top 10 names in 2010, the top 10 names in 2020, they are different. Leadership changes, and you want to make sure you keep how much concentration you have just in check, because this is what can happen. These are a lot of the popular growth ETFs, especially here in the US. These top names are comprising 50, 60% of those portfolios, massively concentrated into just a few names. Rebalancing is important. Keeping this in context is important. And this is one of the byproducts of what's happened over the course of the last 18 months, where we've had some concentrated movement in equities. We do think it's going to start to broaden out, but this is what can happen. It's something to keep in mind, something we're keeping in mind for sure. I don't think, as we switch gears to fixed income, that people understand what we've seen over the course of the last several years. These are all of the historical corrections over the last several decades in bond markets. So all these squiggly lines, I don't need you to get too into the weeds of which year is which on the left-hand side, but you see there was this common thread of 3 to 12 months in length from corrections in the bond market, long-term bond market. What we've seen over the course of the last few years there's a clear outlier and we're living in it. It's just been this drawdown, and it's going to take time for the bond market to recover just because of the hole that was dug over the course of the last several years. The starting place remains pretty strong today, but this has been the frustration across investors who rely on bonds as a big piece of their portfolio to manage risk, drive income. This has really been the story. And this is why, when we talk about not relying just on long duration treasuries, this is one specific part of the portfolio. But I think this is just a representation of just how challenging it's been for fixed income heavy investors. And you think about big institutions like insurance companies, this is where they're heavy in this world right here. So it's been a challenging environment. It will take time to work your way out of, but I always remind people, starting place matters, and looking in the rearview mirror helps understand. But if you're investing today, looking forward, a 5-6% yield in your fixed income will likely be your general return over the course of the next 5 to 10 years. That it won't be perfect, but it's the best predictor of your future returns. It is a good starting place to be. Something to keep in mind as we look forward from a fixed income perspective, because it has been challenging. And it's not just something that you feel, the data backs that up. And this graphically shows just how different this 3 or 4 year period has been. How are we thinking about portfolios? We have been overweight US to international. We like, with the dollar being strong, not only is it at the company level, corporate fundamentals are strong. We see the US consumer remaining pretty strong. We just have this bias towards the US. There are opportunities internationally. We just like to be very concentrated and focused in that space. That's a theme that you've heard from us for the last several years. We do like equity markets. We're cognizant of how expensive they are. We're trying to make sure we're looking outside of those expensive areas, but AI is going to be an important part of equity markets as we move forward. We get the question quite a bit about AI of how do we access it? And to us, it's kind of a fool's errand to try to pick a single company. Naturally, NVIDIA comes to mind. NVIDIA's had a great run, but NVIDIA is kind of the foundation of AI. That's not the 10 years, 20 years from now AI exposure. There's so much that has to get figured out. And on the right-hand side, something I talk about in the newsletter, in the sense of it's going to kind of ripple itself through to a lot of different areas. We don't know exactly where it's going to lead, how long it's going to take. Some markets will adopt it quicker than others, whether it be education, real estate, the financial world, our world, right? Or the banking side, healthcare. Where can this be helpful, and where can it create efficiency and higher productivity? We don't know that yet, but what we do know is it has the ability to increase productivity. And our kind of focus for individuals is, while we have a lean into the semiconductor industry, something that's been a tactical play for us for a while, not just around AI, but just the use of advanced chips across many facets of our lives. AI should really be a focus on owning more equities and just owning equities in general than just going and buying NVIDIA. NVIDIA's had a great run, and it will continue to be a really strong company. Our focus is more on the owning equities because of what you see on the right-hand side. It will help and will change many industries. We think picking that today is way too hard and is still in its infancy to figure out. And on the fixed income side, I think we are focused primarily still in the core investment grade area of our fixed income portfolio, just being a little bit shorter on duration. So not super short term. We believe you shouldn't be all money market today, but we are light high yield. We're light some of those really high risk spread sectors in some ways because of how relatively expensive they are. You're just not being compensated. Part of it is because corporate fundamentals are so strong that default rate expectations are really low. So we're living in the core fixed income space. We do like corporate fixed income, a little shorter duration. That tends to be our preferred positioning today. Andrew, I'll kind of turn it over to you from a Q&A perspective.
Great.
What we got going on?
We're loaded. We got some inquisitive people here, which is great. Mike, that was awesome. Thank you. I think the perspective for me, it's always great listening every time I hear you talk to really make complex things simple and concepts that people can grab onto. So I really appreciate that. No shocker here. Let's go with the first question. Mike, what is your view and implications on, I don't know if everyone's living under a rock, but about 3 months from now, we have a couple 80-year-olds running for president, and should be interesting. How does this play out? How's this affect, I guess, the markets,
I'm not
right?
aware what you're talking about. Haven't
Yeah,
heard.
yeah, we haven't heard this yet. So,
Yeah,
but I think it's a great topic to give your 2 cents on.
yeah, it's we can go in a lot of different directions on the conversation because there's a lot of different tentacles to it. Here's what I'll say. There is a go down to the issue level conversation. Then there's just historical data that we look at. So I'll start at the issue level. Look, we can go back and forth on issue by issue. I think so much of the difference, the reality is social rather than fiscally. And I always remind people we have to separate fiscal changes and preferences and policy from social policy. Social policy is a very personal thing that's emotional, and that's different, right? Let's talk fiscally. I think fiscally, we're actually working right now on some of the differences, and that's actually probably something we'll put out there. I think the reality is practically at the fiscal level, it's not going to be that different, right? I think depending on who wins, it's going to be more volatile. It's going to be more emotional, just from the social aspect of things. Are we going to cut corporate rates? Are we going to cut income rates? Are we going to drive more spending? Are we going to do more spending here or there? A lot of this reality is we're going to run a deficit regardless of who wins. That's the short answer. Are we going to cut taxes? Are we going to increase spending? Both scenarios, we are running a deficit. That is still something we have to keep an eye on. But so much of the differences at the policy level are truly social. We're not overly concerned, regardless of candidate, for the fiscal side of things. I think there's so many aspects of the U.S. economy that I think, regardless of who wins, corporate fundamentals remain pretty strong. Historically, I think is what people should focus on. Of what happens historically in election years. One, we lived through it, 2020, 2016. Things will get volatile. Things will have headline risk. It wouldn't surprise me if things pull back a little bit over the course of the next 3 months. Just, even at 5% in equity markets, just as things get a little choppy, things have performed really well. Doesn't mean that things are going negatively. It just means that people are getting ready for the election. They're starting to see what's going to happen, because they're, candidly, we don't even know what's going to happen with one of the candidates, which is now a major headline. Historically, the big thing to remember is, we've looked at every election year where there was an incumbent running. And the data is interesting. Markets perform really well on average over the course of time whenever there's an incumbent running for re-election. I think it's 13 out of 14 of the last 14. I want to say it's 13 of the last 4 have been positive years in markets. The average is nearly, if not double digits, equity market returns. Why? The incumbent will do what they need to do to try to get the economy in a good place and feeling in a good place leading up to the election. So I think overall, right, if you think about it, naturally people get concerned of there's going to be volatility for sure. But the data tells you that in an election year, when there's an incumbent running, which we still have to figure out if that incumbent is actually going to be running, but if an incumbent is running, markets perform well. They, at least on the equity side. We'll see what happens. We're going to come out with some more information around the differences in policies. I think, at least on the fiscal side, I think that would be helpful for people to really dig into. But candidly, we're not caught in this nuanced difference of which candidate gets in from a fiscal perspective. We're more focused on what happens, how we can make sure people are staying invested. Are there any major policy differences that could ripple through the economy? Nothing that we see today that would cause us to change our stance in remaining invested.
Okay. Next question. With the U.S. Fed making waves on lowering rates later this year and the president's budget increasing spending, how do you project those items impacting the markets?
Yeah. And I think this ties back to what's the big risk from our perspective in markets. And it may not be short term. U.S. Treasury issuance, US deficits, US debt is naturally the concern, right? Higher rates, the Fed having to issue treasuries at higher rates is not ideal. At that point, they're having to pay higher interest expense. To me, the biggest ripple that we have to keep an eye on is really long-term rates over the course of time. So even if rates get cut, I think people just sit here today and assume rates are going to go down across the board. And I'd say that that's probably not the fair analysis looking forward. Short-term rates will come down, but if the US continues to run deficits, right? And even if rates come down, we're still going to run deficits. And what'll happen is investors will require term premiums for 10 and 30-year treasuries because of the mounting debt load that will keep rates kind of where they are, if not elevated. We do think that there is a floor on intermediate and long-term rates because of debt levels. And there's always exogenous concerns around, the depreciation of the US dollar and what happens with that. I think that will naturally favor international equities. At least that's what, of course, historically would have happened for a US investor. But rates coming down, it'll be slow. The Treasury is still going to have to continue issuing debt. That's not going to change. And I think what really the ramification is over the long term is just intermediate and long term rates kind of have a floor. Not everything is going to be or should be assumed to come down as the Fed cuts. There are ramifications for continuing to increase debt levels. It may not be a 1 or 2 year issue, but to me, that's a long-term ramification of long-term rates are likely going to have a floor, and US dollar will likely depreciate at some point, right? And that's just naturally what's going to happen at some point.
Okay, so there's two questions, not identical, but they're on. Since you're talking rates, let me read them both to you and let you tackle them as you see fit. So first one on rates is, if housing remains in its current state, what do you see bank rates doing following rate reductions by the Fed in the market? Assuming they're talking mortgage rates, right? And then second question, both from anonymous attendee, so we don't know, maybe it is the same person, but do you think there is a possibility the Fed will cut rates to make the current administration look better in the short term by juicing the economy at the expense of sound economic evidence? If so, how would you know, and how would you defend our portfolios if needed?
The what you know is you won't know. Right? At the end of the day, you don't have the transparency. We have transparency into what the Fed is doing in the sense of minutes and press conferences. You'll never know what's in somebody's head, heart, in terms of, are they biased to do it for a certain reason? Here's what I'll say is, the Fed is designed to be independent. And they've had many opportunities where they could have cut rates over the course of the last year. I don't see them bucking that trend just for the sake of doing. I also don't think them cutting rates by 25 basis points is necessarily a bad thing. I just don't think it's necessary yet either.
Yeah, and Mike, adding to that, if I may, is I was going to say the same thing if you didn't, that the Fed is designed, even the terms aren't 4 years. What are they, 7?
Yeah, Jay Powell, I believe,
Well,
was a Trump appointee. So
yeah, but that was my second point is Powell was nominated by Trump. So Powell was nominated by Trump. He's got a 7-year, I believe, term. And to your point, they run completely independent. So I would agree with that statement as well.
They're going to be independent. I think I love the old saying, our biggest biases are the idea that we don't have any biases. Well, we all do, right? But that doesn't mean that they aren't data dependent, which I think they have proven they are. They are being patient. Will they cut in September? There is a chance that they cut in September. Sure. Is it because of the election? I have a hard time saying yes. I also don't think there's a reason that they need to yet. They know that they've raised rates beyond where they need to. They know the long-term short, the long run short-term rate that they would maintain is lower. It is not 5.25 where it's at today. It should be closer in the 3.5% range. What does that do to mortgage rates? I mean, mortgage rates will come down. It will be slow. It could, because every time the Fed cuts rates, it will likely be 25 basis points, so 0.25%, unless something breaks. So I don't think that's going to really change the housing market a ton. It gives some people the opportunity to hopefully refinance. You may see that activity picking up, but I don't think it changes the housing market. I still think we need more houses built. There's not enough supply. People are stuck on mortgages that are 3% or sub 3%. Rates getting cut 50 basis points doesn't change the idea that they have to give up that debt for something pretty expensive relative.
And follow up with the housing question real quick. What they lower rates, what happens to mortgages?
I don't think much. I think you'll see refis get picked up, but no, I don't think housing market is going to change much if we see 25, 50 basis points cut. I still think you're seeing some home building activity, but you're not seeing a ton. I think most of it will be in refinance. Housing prices are still expensive. That's not going to be solved with 1 or 2 rate cuts. I still think the housing market's going to remain where it's at for now. And the long-term structural problems we have in housing require other things, right? It requires more supply. It probably requires a longer runway of rate cuts. But yeah, I don't think largely a rate cut or two is going to affect the housing market all that much. And like I said, I don't know that they'll cut rates in September. It wouldn't surprise me if they cut once. And I think it has less to do with the election and more to do with it's been over a year and they're comfortable with where inflation's going, or they're seeing softening in labor markets that they want to start the process. Because it's going to be a process of, at 25 basis points, it's going to take several cuts and a couple of years to get down to where they want to go.
Right, makes sense. And they don't seem to be rushing. Okay, got 3 more that may take us to the end here, but I don't think they're long ones. First, Mike, have we hit the are you claiming we hit the soft landing that a lot of people were hoping for and maybe predicting?
Yeah.
Yeah.
I do. I think the economy has remained strong enough where we are not seeing economic growth drop far enough or even show softening yet to where we say recession is close yet, right? Things can change, something can break. Inflation is close. I think the story has been either soft landing or no landing. We're not at soft landing yet. Getting from 3 to 3.5%, just so everybody knows, the difference between the soft landing and no landing is really just, does inflation get down to where it needs to be, or does inflation remain elevated and we just kind of live in this 3.5% inflation world for the foreseeable future. So I think we are currently kind of at no landing-ish. The question is, can we get down on the inflation front to 2.5%? I think we're looking into next year probably for that, most likely. But I do think the soft landing scenario is playing out.
Awesome. Music to all of our ears. All right. I guess let's bring her home with these last 2. Right. Do you see the new BRCS currency becoming a reality? If so, how bad will it affect US dollar?
Candidly, I don't think I have enough of a background in that space. I'll probably have to follow up with something along those lines. Here's what I'll say though is we've been talking the currency world, right? Whether it be digital dollar or crypto, BRCS, like all these different areas, there's a lot that would need to happen. But I'll have to follow up. I would say let's follow up on that because I think it requires more research and probably more thought than I'd be able to give at this point.
Okay. All right, well, we thank you. I guess we got another one snuck in here, and I think we still got a few minutes. Are you currently hedging for a market correction?
A little bit, not much. I think what we're doing is we are understanding that markets have had a really good run, and we are content having a slice of our portfolio give us a little bit of protection if we see some little bit of correction. Naturally, I think at the highest level, we are always diversified, right? We are trying to manage risk. However, we want to make sure we're keeping that upside because equity markets will drive our returns over the course of time. And we have to be exposed to equity markets to really, you want to talk about keeping up and outpacing inflation. Equity markets have done it extremely well for 2 centuries at this point. But we do always have that in the back of our mind of how can we hedge ourselves and diversify ourselves, even within equities, to give ourselves some ability just to protect in case of some correction. So we are small. It's not a very large allocation, but for us, we always have that little bit of hedge piece, just to protect, at least in more recent times, something breaking. Or inflation reaccelerating for any way, which is not our base case, right? That is, if it were our base case, we would have a much different conversation. But we are having a slight hedge at this point.
Okay. It's a slight hedge, not super strong at this, based on what you're saying. Last question. So, ... This talk of raising tariffs will not impact economy. Example, inflation, question mark.
Well, I think we're talking globalization in general. I think the idea of globalization helping, it's the downside. It's always the outsourcing of jobs. Well, the outsourcing of jobs through globalization creates efficiencies of outsourcing manufacturing jobs that many US individuals don't want to do for the price that companies are willing to pay, to do it at a very reasonable price. And now what you're seeing is this change where you're having nearshoring, right? So countries like Mexico are benefiting from the US not wanting to have outsourced to East Asia, for example, or Southeast Asia, as much to limit supply chains. Look, tariffs are not ideal, right? I mean, I think tariffs limit free flow of goods, but you look across the world, I think you're starting to see more protectionist type of policies in the EU. You're seeing the same type of thing to try to protect domestic markets. So, look, it's certainly foreign policy in the sense of tariffs have the ability to affect the economy. I think deglobalization has the ability to affect the economy through potentially inflation for sure. And we may have to get used to living in a world of 3 or 4% inflation. We'll see. I would say we lived in 2-3 decades of extremely low rates, and the Fed couldn't get inflation to 2%, right? As much as they've tried, and so it hasn't been an issue. It is now. It may change with deglobalization for sure. But this is kind of where you start to think about where at the end of the day where these policies could take it and how likely they are. I know a big one right now is the EV market and those conversations. So, we'll see, but for sure tariffs have an effect. And I think it's all around deglobalization in general.
Love it. Mike, thank you for your time, your knowledge, your support, your calmness through it all. I know our clients really appreciate it. We will be sharing this with everyone digitally. Please feel free to send it along to friends or colleagues that you think would appreciate it. We always aim to please and help as many people as we can. So thank you. We'll see you next quarter. Keep a look for this in Mike's quarterly newsletter. Cheers, everyone. Bye.